Welcome back to Rich Dad Stockcast. I'm your host, Del Denney, and today we're going to flip your thinking about one of the most feared words in investing, loss. Now, most people avoid talking about their losses, but the best investors, they study them, they learn from them, and in many cases, the losses end up becoming their biggest breakthroughs, and no one understands that better than today's guest, Rich Dad expert Andy Tanner, who's joining me to talk about the trades that didn't go right and why they matter more than the ones that did. But first, if you're serious about becoming a smarter investor, go to stockcastbonus.com. Grab your free tools. These are resources that can help you to understand your investments better and grow real cash flow. That's stockcastbonus.com. Go there. Andy, welcome back to the show.
Del, thanks for having me. This is quite a topic. How much time do we have?
I know, right? I love this topic because no one wants to talk about it, right? But we're going to go there.
I don't mind talking about it at all. I think you're right. I think there's great lessons, and if you can learn from the mistakes of others, even better.
Even better. Now, before we do that, you know, you've put so much knowledge into stockcastbonus.com, always updating. There's always great resources there. What do our listeners receive when they go there?
There's some great stuff. We've got free webinars. We've got free downloads, ebooks. So many things for the action takers. One thing that I know for sure is that knowledge is critical, and then applying that knowledge is critical. And so knowing what to do is the education part. Doing it is about habits. It probably rings true even to a person without a wealth mindset yet, that the habits that you engage in every single day, you know, that builds your life. That allows you to impact the world rather than just be impacted by the world, you know, impacted upon by the world. And so that's what Stockcast Bonus is for people that want to dig in, dive in, and start putting some action to the content they consume. You know, it's fun. I don't spend you know, a lot of time. How can I put this? There's a lot of consumption of content that people can get that's random, that's here, there, 15-second bits and things like that. To have a school and to have a consistent, organized plan that instills habits in people brings a lot more wealth than just dopamine hits alone. So there you have it. That's stockcastbonus.com, and a lot of the stuff there's no charge. So hop in, not a lot to lose and a whole lot to gain.
Indeed. Thank you for sharing that. Now, speaking of sharing, we're going to be talking about losses today. And you know, again, a lot of people want, especially on social media, talk about dopamine hits. Everyone's showing their highlight reel. They don't really show the losses and the struggles that people go through. But let's start here. Andy, most people are afraid to lose money, but losses can be some of the most valuable experiences in investing. Now, why is that? Let's just start there.
Well, maybe if I hate changing your question too much, but what comes to mind first is that the ability to have a loss, just as an investor, it's absolutely critical that's something that you accept and something that's going to happen. Anyone who does this for any significant amount of time at all and sticks with it is going to have drawdowns. They're going to have times where a transaction does not go the way they want. They're going to have a loss. And so I think that's one of the things that keeps people from success and keeps them out of investing. And, you know, my two sons, I put them in basketball or, you know, whatever sport they want. They chose basketball because they're tall like their dad. But, you know, when we put them in jiu-jitsu, I remember my son had a pretty big loss in his first match in his first tournament. This guy whipped him. I mean, he just got mentally, physically overwhelmed, and he had to go back out on the mat. Well, he didn't have to, but he chose to. And we had a discussion where he didn't want to do it again. He says, I want to lose again. That was awful. That was a physical, you know, and he was young when it happened. And he got back out on the mat. All of them have struck out at the plate. Both my kids have struck out at the plate. Both of them been popped in football and had their bell rung, and they've had missed shots. And my younger son dealt with it maybe not quite as well as my older son, just because he's so passionate about winning. He's much more passionate about, he's less stoic than his brother. And I sat him down and I said, Steph Curry misses more than he makes. The best guy who's ever done it, as far as shooting the basketball, Kobe has the record for misses. He's missed more than anybody. That guy never met a shot he didn't like. And so the ability to miss exposes you to the ability to make it. The risk of missing also carries a certain probability of making it too. So before we talk about losses, coming to the point, think about how many investors never click the mouse because they want to guarantee that it's going to work every single time. And that's just not the case. And so if Steph Curry is only going to shoot 40% from three, that means he's going to miss the majority of the time. And how you deal with that mentally is a huge, huge key. So before we even learn, before Curry starts to analyze his shot and say, well, what did I do wrong on this one? And were my mechanics bad? And why did I miss this shot? He's first got to accept that he's not going to hit all of them. Now he's going to strive to hit all of them. He's going to train like he wants to hit all of them, but he's not. And so that's the first thing that the first lesson in and of itself is, no matter how hard you work at batting 1,000, that's just not reality. That's just not how the world works. You're gonna get punched in the nose, and the ability to minimize that, to deal with that, is a huge thing. So I would just say that before we even hop in, start sharing some of my losses, some of the stuff I've had. Everybody has them. Warren Buffett, almost without fail, starts his annual letter with his mistakes. Here's the mistakes I made. Not every year, but most years. We paid too much for Kraft Heinz. We paid too much for it. But stuff like that.
Maybe I'd like to take it maybe a little bit further. Robert's talked about the difference between A students and C students and that perfectionism that comes along with it. For the listeners that are unaware of kind of that mentality shift, what is the difference and what's the danger of the A student going into the market?
Yeah, A students want to get 100% on their test all the time, and that's something that's possible. You can practice tests and, go to your teacher and, make sure that you get in your paper trade account and trade perfectly, so to speak, before you get in the real thing. And that's fine for academia, but academia is only part of what I call the education continuum. It's competency, where you kind of know what you're doing, but proficiency, which means we're going to be doing this as a professional, a profession. It's something where we actually do it. You're not going to bat 1,000. So the A students can do very, very well because they're willing to study it. But the temperament is another part of this, and the habits are another part of this. And so that, there's nothing wrong with A students. Robert doesn't like them because he was an A student. I was far from an A student, man. I struggled in school because I hated it and I wasn't very smart. I wasn't very book smart. But anyone can learn how to do it. C student, D student, people who flunked out, tomorrow's a new day. So, the A students do not make bad investors at all. They're A students. But they do, it's not a guarantee. There's a temperament that a person gains that perfection, we want to strive for that. Nothing wrong with striving for perfection. But expecting it is different than striving for it.
There you go. All right. Now, let's transition to your own trades. Can you share a time when a trade didn't go your way, and what did you learn from it?
Zillion of them. A zillion of them. One of the things I did is I let my probabilities, when you think about investing, and even more so trading in the markets, both this applies. is you're juggling three balls in the air. You have first is reward. And reward is what it makes the investment attractive. If the reward is not significant to help a person achieve their goals, they shouldn't be taking then any risk associated with it is too much. In other words, if you have a wealth plan that includes a 401k, and you look at that, you realize the 401k doesn't have the horsepower to get you where you want to go, why put any risk in that? So that's really important to understand the reward of an investment, not just a general attitude of, well, I can make a lot of money here. If the reward is not big enough, then no risk is worth it, because it's not a car. It's kind of like this. If your goal to go to Hawaii, swimming is not an option. It's just no one's ever done that. Riding a bicycle, not an option. It's a better vehicle than trying to swim it, but not an option. Driving a car, not an option. A boat, maybe. 747, probably your best option. So once I decide that it has the horsepower to get there, now I start talking about, all right, well, this is a big metal tube in the air at 30,000 feet. What are the risks, right? And the risks are significant. Being in a big metal tube, 30,000 feet, has tremendous potential to go south. And so some people say, well, I have a fear of flying. And then the third ball you juggle, yeah, but what are the probabilities of success? Well, they're really, 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 really high. And so you juggle those three balls. One of the mistakes I made very, very early is I was building confidence and probabilities in trading are interesting. Some of the credit trades you can do, I've settled on about a 90% probability for most of the credit trades I do, meaning that I click a button, I get paid, and 90% of the time I get to keep the money. 10% of the time I got to give some of it back, all of it back, or maybe even more than I got back. And so you really want to monitor that stuff. And when a trade does go south 10% of the time, you definitely want to be there to do something with it. You don't need to be glued at your computer. You don't need to sit and watch it all day, but there's alerts that you can set, and you'll be fine. Well, I was trading Apple, and I was doing some real basic credit spreads, nothing fancy. But I had two mistakes. Number one, they'd gone so well and been such a cash cow that my greed got me a little bit. I got a little bit bigger position size that I wanted. And then the other thing that happened is I was invited to go on a cruise ship. Now, this is back before, it wouldn't be a problem now, but back in the day, the cruise ships didn't have any internet. And so I was going to be about 5 days at sea on one segment where I wouldn't be able to check anything, see anything, or whatever. And I looked at where the stock was, and it had to go up to hurt me, not down. And I'm like, there's no way it's going to get there. I really don't want to get out of this trade because I'm going on a cruise, and, my probabilities are fine. And those are the famous words, oh, it'll be fine. And risk is about control. And once I set foot on that cruise ship, I had no ability to control or adjust. And when you have no control, you're gambling. So the way Robert used to write this on a flip chart, he'd say, risk is related to control. More control, less risk. Less control, more risk. And I would add to that, no control is gambling. And if you gamble, you're very, very much likely to lose. So I hopped on there, and that was a very expensive trip. It was definitely cost me a lot more than the ticket price to get a ticket to go on the cruise. That's for sure. So that was a nice little seminar I put on for myself. And what's funny is when people look at those losses, that was a lack of discipline as much as it was a lack of education, mostly a lack of discipline. Well, that was many, that was decades ago. But nonetheless, that's a lesson that stuck with me that I learned from it. I says, you know what? You don't You don't mess with the casino. If you're going to be the house, you have to keep your rules every time someone rolls the dice. If you want to be the house, and if you want to make money off the gamblers, your rules have to be there every single time. You don't get to turn your back on the ocean. So there's one of 1,000 we could talk about.
Let's do this. I want to go into maybe a few more of those, but let's take a quick break before we do. Now, listeners, most people panic when they lose, but the truth is the best investors are built in the losses and not in the wins, as you just seen there. Now, when we come back, Andy's going to break down how to build a system that helps you to learn from your mistakes without blowing up your account. And we'll talk about how to bounce back from a bad trade stronger and smarter. And don't forget, head to stockcastbonus.com to get your free tools and resources that help you turn every investing experience, good or bad, into long-term wealth. Stick around. We'll be right back.
So far, it's been great. I needed a source where I could really enrich my education through stocks. I didn't really have an avenue for it, and it's helped me a lot. The simplicity has really gotten me on the track to where I enjoy the learning as well as it's really solidifying in my mind. And like, they're not just trying to sell you something, they really care about the people that are in the course, and they really do care about you and your personal goals, and what you want to do is to help you and your family and whatever your goals are in life through that. So it's really been great.
Welcome back to Rich Dad Stockcast. We're talking with Andy Tanner about the power of losses. And now it's time to go deeper into how to turn those losses into lessons that pay off. Now, Andy, you did tease us with a few more mistakes that you had. I can relate because Apple was my biggest mistake. I did make an Apple trade early on where I had to learn at a seminar, if you will, from it. But let's continue forward. Maybe our listeners would like to hear a little bit more as you think about the losses, whether it's Apple or it's something else. What else comes to mind in the mistakes and the lessons learned?
I've had losses in every asset class. Real estate, though, real estate's interesting. I don't know that I could really say I lost. I just invested and didn't get paid for a while during COVID. So there were almost all syndications froze their distributions. I don't know of any. I'm sure there were some, but I don't know of any. I certainly wasn't in any that kept paying during COVID, right? Because no one was paying their mortgage, and such a high percentage of people were not paying their rent, rather, that it was really, really tough for anyone to give a distribution out. So, is that really a loss? I don't know. Is that really a mistake? I don't think it is. I'd do it again because you still own the asset. In business, I've lost a lot of money starting businesses, especially when I was young. And that's just comes from a lack of experience, but every single one of those things was such a learning experience. As I look at the BI triangle, the business investor triangle, and I look at the losses I've had in businesses that I started that didn't make it, boy, you can just see where I was lacking in my BI triangle. Well, I didn't know what a BI triangle was in those days, so you learn from these things. I remember I remember that I really wanted to be an entrepreneur, really wanted to be an investor, really, really deeply, enough to where I would put my money out there. And I was approached by a good friend of mine who had a group of people who were wildly successful. And they said, hey, let's put some money into this thing. And as I looked at it from my life experience, I thought, yeah, there's a lot of good about this, but there's a couple things about it that bother me that don't look right. But I thought, you know what? These guys know business. They've been in business. They haven't had the same life experience I have, but they're smarter than me. So I'll throw my money in with them. And that's the fastest money I've ever lost in my life, when I invested with those guys. And it was interesting because I didn't trust myself, and I didn't have the confidence to put forth to that group, say, guys, I can see why this is an attractive investment, but I also have these two issues that I think could be fatal to the business. And I didn't voice those because, and this is really embarrassing, I simply didn't voice them because I didn't want to look stupid. I didn't want to question their brilliance. I didn't want to have them say, well, Andy's not very smart because, he's saying this stuff. I didn't want to be corrected by them. I figured, well, they know what they're doing. Surely they see this. And one of the two issues I had was one of the things that brought a close to that business so fast you couldn't believe it. It was brought to bear. And I actually did them a disservice by not. They came to me not just because I had money, but because I had expertise in a certain area of that business. And I did not voice my concerns about it. And I actually did them a disservice and me. Now, the good news is I've invested with those guys since then. We all forgave each other for that and done well in other areas. But that might have been the fastest money I've ever lost in my life. I just lit it on fire. So I don't know that everybody has made the mistakes I've made. I think they have. I think almost every investor could tell a war story where they lost the battle, and had to go back and retool to fight the war. So if you want to talk about lessons learned, you're going to find they're usually in two categories. There was a flaw in our education. We were kicking our coverage there. We were above our pay grade. We were messing around with investments that we didn't know about. That happens a lot with things like Bitcoins, stocks. What happens in all the asset classes? People disrespect the education. Think about any other, Del, think about any other venture. My brother is a homicide detective. There's a certain amount of training and education that is required, not suggested, it'd be nice if he was trained. There's just certain training to be a police officer and a homicide detective that is absolutely prerequisite. Doctors, lawyers, accountants, engineers, electricians, contractors, all of these have minimal competency tests that people pass, some type of minimal threshold of knowledge to engage in that. And yet when it comes to investing, people want tips. And so they're asking for trouble if they disrespect and think that investing would be unique or easier, if it's probably harder than all of those other things, or more people would do it. So the first thing is overall, learn before you earn. That is the biggest mistake. You can either learn from mentors and coaches and other people, or you can learn from experience. And it's much, 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 much better to learn from mentors and from people, because it's okay to have a loss. You're going to have losses. Experts have losses. The key is how big are they and how devastating. That little cruise ship loss, we'll call it, that wiped out a year of profits from Apple. So all of the profits that I'd been crushing every single month, it wiped out the whole thing, wiped it all out and then some. And so I still had my shares of Apple. These were option trades. Now that's overcome. We've made more, over the years, but it took out about a year just because I was being stupid. So knowledge is a big thing. The other part of it is temperament. Is often human nature is that we make mistakes where we knew better. And when we look back, it's like, I knew better than to do that. I knew better than to say that. It was a lack of judgment. When emotion goes up, intelligence goes down. And the emotions of greed and panic, greed of what got me on the cruise ship one, right? Greed can get you. You start investing in things looking for rewards without really having a sound temperament about yourself. I think Warren Buffett and Charlie Munger, those two guys, their brilliance is unquestioned, their knowledge is unquestioned, but it often overshadows their tremendous temperament that they have. And so generally when you make a big mistake, it's going to be a lack of knowledge and temperament. Now that's different. That's different than a loss that is small and fairly harmless. Something that it's not cancer. It's you caught a cold, right? It's a different level of injury or lack of injury. You just got hit in the face. You didn't get injured. You got hit in the face. And there's a difference between getting slapped in the face and getting injured. And if you have a proper temperament and you have proper knowledge, those losses are manageable, right? They're manageable. I have losses in my options trading, a little less than 10% of the time, but they're not devastating losses. It's more like a casino who loses a hand of 21 to their client, right? It's not devastating. There's a table limit there. Here, congratulations, sir, you won, right? Congratulations on your win. But it isn't devastating to the overall process of the business. So separating out small losses from big mistakes, a small loss is not a mistake. Let me use a basketball analogy again. If my son misses a shot, that's not a mistake. In other words, a missed shot isn't necessarily a bad shot. That's really important for people to understand. A trade that does not turn a profit isn't necessarily a bad trade. When I coach my kids in basketball, I say, look, there's 4 or 5 things you need that determines whether you shoot a basketball. Number one, you should be open. That's a criteria. It's an analysis. Did you have to rush it to get it off? If you did, you weren't open. You had to hurry. If you're open, you get to shoot the same shot that you shoot in the gym at the same speed. Number 2, are you on balance? In other words, was the pass in the proper area? Did you have to get out of balance to catch the pass? Or were your feet prepared before you caught the ball? Are you on balance? Number 3, are you taking a shot that's within your range? Is it within your pay grade? Have you shot enough shots in a practice and in scrimmages that proves that you shoot a percentage that's acceptable for the probabilities of the game? Next, is it a team shot? Was there someone that was closer to the basket, more open than you, that you should have passed it to? And then finally, what's the time and the score? And so we have a list of criteria. This is going to apply to investing. If he checks those boxes, and he checks all of those boxes, that's a good shot, and you should take it. Whether it goes in or not is not relevant. It's a good shot. So we're playing in his senior year, we're playing in a high school game, and it's heated, man. It's brutal. And it's down to the wire, and we're down by 1, and he shoots a 3, and he misses. And, many people think, well, that might have been, a bad shot because he missed it. And it would have been a game winner. It was at the time and score where there were a few seconds left, and somehow we were able to push it to overtime. We got lucky. Our best player fouled out, and it's a big drama. But yet later in that overtime, he took the exact same shot and and he hit it, and he hit the game winner. So those shots were identical. They were absolutely identical. Same criteria, same boxes checked. There's no difference. One went in, one didn't. And they're both great shots. Well, when you look at investing, it's the same thing. You say, did this fit my criteria? And if it did, win or lose, it's a great shot. It's a great investment. And part of that criteria is your risk management. And if your risk management's in place, you can miss some shots but still win games and still get in a championship situation where you have a chance to do things that are special. So really separate mistakes from losses, because I have that's the way Kobe and Steph look at it. It was a great shot. It was what I'm supposed to do, and if I keep doing that overall, I'll win the games. That's not a loss. Is not a mistake. A loss is not a mistake. A dry hole in oil is not a mistake. We did all the research. We did dry hole. Okay, well, let's drill another. Oh, gusher. So separating your mind from a loss is different than a mistake. The cruise was a mistake. That was a huge loss. It was stupid. It didn't need to be. It wiped out. If I kept doing that, you'd fail. But the losses I have nowadays are not a mistake. If I hedge and the market goes up and I lose some money on the hedge, That's like you didn't lose because you bought insurance on your car. You lost some money, but it wasn't a mistake, right? You didn't lose big. You didn't have a devastating loss because you didn't collect the insurance on your car. You paid for insurance, had a loss, but it made sense because it protected you. So that's why knowledge is important, is to know what the criteria are. Then the temperament is important, that my son doesn't shoot stupid shots. Because if you shoot a stupid shot trying to get back in the game too early, or a rush shot, or believing overconfident that you're better than you are, taking shots with outside of your range. Well, I'm at 30 feet, but hey, maybe it goes in. I just jacked this one. That's a lack of temperament. That's a lack of habit, lack of discipline. So you got to have both. You got to know what the criteria is, and then the discipline to follow the criteria.
And Andy, that was so powerful right there. I love that. And also thinking, I wish you were my basketball coach growing up with that checklist right there. But
you're a good player. You don't need me. I've seen you play.
Well, I think being from Indiana, you're born with a basketball, and there's an inherent a little bit of basketball skills that come along with that.
Expectation. Yeah.
Indeed it is. Last question. Where should someone go to start learning how to invest with a smarter mindset?
A lot of great resources. There's a paid class on Rich Dad for $100 that's called Zero to Cash Flow. So for $100, I'll take someone by the hand. It's a multi-hour class. And for $100, I'll take you by the hand, take you from zero to cash flow. And the purpose of that class is to establish an income stream for someone. If you haven't taken that, if $100 is above your pay grade, which that really means something. Like if I say, hey, I got $100 class, that's not law school for $500,000, right? It's $100. So if someone says, gee, I have $100, then the need to learn financial education should be obvious to you. So if that's the case, then get some free education at our Stockcast bonus.com, stockcastbonus.com. There's free stuff there. There is no excuse. That's why I love the free stuff, is it takes away every excuse. And this is a beautiful thing, because if a person has free resources and they're invited to receive their free resources, they don't have the ability to complain about money ever again, because there is a way to learn. There is a way to spin straw into gold. There is a way to get that stuff done. So regardless of who you are or where you are, that's really a temperament issue, right? Am I committed enough to my dreams to put in some time to learn important principles from people who've done it 1,000 times? So those are the resources those are a couple resources you could go to. I think the cash flow game is a couple $100. You could buy one of those for a couple $100, or you could take a class for $100, or get the free resources. But do something. When this podcast closes, when this YouTube video ends, go to stockcastbonus.com and do something. Doing nothing brings no wealth, and doing something brings wealth. So that's what I would say to get started. Is there's no shortage of resources to do things.
There we go. There we have it. Listener, losses aren't just a part of investing. They're a part of the education. So if you treat every mistake like a tuition payment, you'll walk away smarter, sharper, more prepared for the next opportunity. Again, big thanks to Andy Tanner for sharing not just the wins, but the losses as well. There's some real wisdom behind them. And don't forget to go to stockcastbonus.com. Grab your free investing tools, whether you're recovering from a bad trade or just getting started. These resources will help you to build smarter strategies and stronger discipline. And if this episode has helped you, make sure you like it, subscribe, share it with someone who's trying to get better at investing as well. Listener, you're not here by accident. You're building something that most people won't. So stay smart, stay invested, and we'll see you next time.
This podcast is a presentation of Rich Dad Media Network.